Take a look at this. The average post-World War II recession has lasted 10 months. That article was from Forbes. And if we back up a little bit and we go back from the 1850s until now, the average recession lasted 17 months. Now, part of the reason why the average recession length has gotten shorter over the last number of decades is partially because in 1913, the Federal Reserve Bank was created, and then the Fed had the ability to manipulate our monetary supply by printing more money or cutting interest rates, which allows them to stimulate and influence the economy, especially when we're in a recession. But here's what I want you to remember. Recessions happen and nobody can perfectly predict when. Recessions generally happen when nobody expects it to happen. Right now, the Federal Reserve Bank is saying that they expect a recession to happen by the end of 2023. Now, will that happen? Who knows? But the reality is we're seeing a lot of red flags in our economy. Maybe the real pain for the recession won't happen until later on. But now, this is where you want to be paying attention to what's happening and know that just because everybody's saying something's going to happen at a certain time doesn't mean that it's going to happen exactly at that time. But if you understand that recessions happen and you understand how long recessions last, it might help you manage and invest your money a little bit better. Take a look at this. In 1945, we had a recession that lasted 8 months. In 1949, it lasted 11 months. In 1953, a recession lasted 10 months. In 1958, a recession lasted 8 months. 1960, 10 months. 1969, 11 months. 1943, 16 months. 1980, 6 months. 1981, 16 months. 1990, 8 months. 2001, 8 months. 2008, 18 months. And 2020, 2 months. While the majority of people are arguing over whether or not we're going to see a recession, I want you to understand that recessions happen, know how to prepare for them, that way you can capitalize on a recession. There are a lot of recession indicators out there. Every economist has their own recession indicator that they look at, but let's take a look at a couple of them. Number one is the Warren Buffett indicator, the Buffett indicator, which takes a look at stock valuations. And what it says is that when stock valuations get so hot, that is an indicator of a recession. So think of it this way. If you start a company that's making $100,000 a year in profit, how much is this company actually worth? Is it worth 10 times your earnings, $1 million? Is it worth 15 times your earnings, $1.5 million? Is it worth 20 times your earnings, $2 million? Or is it worth 50 times earnings, $5 million? And it's really just going to depend on, one, what type of company you have, but then also how strong is the economy and how much free money is available. When you have a lot of money available, when you have access to cheap debt and a lot of quantitative easing and a lot of stimulus, a lot of dollars out there, valuations naturally rise because people and investors and institutions have access to more money. And so now these institutions are going to be fighting each other to invest into your company or buy your company, which then pushes up valuations. Right? There's a lot of demand for your company, which pushes up the price. So what the Buffett indicator says is that when they see valuations rise significantly, that is an indication of a hot period in the economy, which ultimately, when the economy gets too hot, it's going to have to cool down. And that's what the Buffett indicator says. And we've been seeing this Buffett indicator start to cool down, but it has been saying in the past that we are in a hot territory. Some investors look at the yield curve indicator, which says essentially, if I'm going to lend my money to the government for 10 years, I would expect a better rate of return than if I'm investing my money and giving my money to the government for 2 years. And that makes sense because if I'm investing my money for a longer period of time, it's riskier to me, so I deserve a better rate of return. But when that flips, meaning I'm getting a higher rate of return by lending my money to the government for 2 years as opposed to lending it for 10 years, that is an indicator of a potential recession coming because it means that people are worried about the long-term health of the economy, the dollar, and the government. And so they don't want to lend their money to the government for the long term for 10 years because I'd rather get a better rate of return today. So if you're getting a better rate of return in the short term by lending your money for a short period of time, you don't have much incentive to invest your money for the long term because you're getting a better return by lending your money for a shorter period of time. This is what some people also call a recession indicator when you see this type of inverted yield curve. Now, it doesn't really matter which indicators you're looking at because at its core, a recession ultimately comes down to the exact same things. It means that people are not or do not have the ability to continue spending money because our economy runs on spending. The more money you spend, the more money somebody else makes. When you go to Sweetgreen and you buy a bunch of stuff, they make more money. If Sweetgreen makes more money, they have the ability to open more stores, hire more people, create better products. If you're not spending money at Sweetgreen, they don't have the ability to open more stores. They don't have the ability to hire more people. And when you see that happen in the broader economy, the economy then slows down. So the economy runs on spending. And when people are spending, businesses make money, the economy grows. When people are not spending, businesses don't make money, the economy is shrinking. And so when you see a recession happen, that means people don't have the ability to spend. What causes people to lose their ability to spend? Well, you could say if businesses are doing layoffs, they don't have the ability to spend. And that's correct. But what's going to cause a business to do layoffs? Because if a business is growing and they're making money hand over fist, they're not going to do layoffs. There has to be something that triggers the layoffs. And the layoffs and the slowdown is triggered by people's reduced spending. Because if a business sees their revenues or their profits fall, that's what's going to trigger them to do the layoffs. So what ultimately causes people to not spend their money? And this goes down to consumers and businesses' spending ability. When people have the money to spend, they can and will spend. When people don't have the ability to spend, they won't. And when I say money, I don't just mean the money that you're working to earn. I mean money in our economic system, which means the money you work to earn from a job and also credit. We live in a credit-based society, which means the money in our economic system is the money you work to earn, the money in your savings account, and the credit you can qualify for. And so now, when people go out and you spend, well, what we see happen is people then continue spending even beyond their means, because now you can go and put some money in your credit card, you can get a home equity line of credit, you can go and get some loans, and so now you can spend, and then ultimately you hit a breaking point because now you spent too much money. You have the money that you're working to earn, and you've maxed out your credit cards, you've maxed out the debt, and now the money you're working to earn has to go to paying down your previous debts as opposed to buying more things. When this happens in a collective, that means now people, businesses have spent it all. You've overspent, and now instead of going out and spending more, you have to work to pay down and pay back your previous purchases. When you enter that phase in the economy, now spending has to go down unless something changes on the credit side, meaning the Fed makes more money available, loosening credit standards or whatnot. But in general, if that happens and spending ability decreases, well, now people are working not to buy more things, not to buy more Sweetgreen, but to just pay back all the credit card bills. And when that happens, you see a slowdown in spending because people can't go out and shop. They can't go out and buy more things. They can't go out and spend freely like they could before because now they have spent too much, and now you're working to pay down the debt. When you enter that breaking point where now people are working to pay back bills as opposed to creating more bills, that's what then causes the slowdown. And when you start to see that slowdown, well, that triggers the next domino. It's a game of dominoes at this point because now the spending slows down. That means businesses see less revenue. If businesses see less revenue, well, some businesses are going to go bankrupt, maybe because they had too much debt, maybe because they were mismanaged. They might just go straight up bankrupt. Other businesses will say, okay, now we need to readjust. We need to lean our operations. They might let go of some divisions. They might lay off some people. When you see these things happen, that then triggers the next domino, which is people lose their incomes. When people lose their incomes, well, you also don't have the ability to spend. And you might not have the ability to pay back your debts either. So now you have the next domino, which is not only are people not spending, but now people don't have the ability to pay back their bills because they're losing their income. And then when that happens, that's when the banking sector starts to get hurt because now banks are not getting their money back. They're not getting their loans back. So you can start to see it's a game of dominoes, but it all starts with the spending. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. And let's take this analysis and put it to what's going on today, because what we've been seeing happen after 2020 especially is we saw a huge ability for people to load up on credit because interest rates were so low. And so we saw people spend because one, they had access to this credit. And then second, because, well, inflation made everything so much more expensive. So people had to spend more money to buy things. And in the beginning, it wasn't that big of a deal because people had stimulus checks, they had unemployment checks. People had the ability to spend. Well, now as that free money is going away, as the price of things are still high, and now as interest rates are getting higher, we're starting to see the real effects of that. And the first effect of that is on the debt side. We are seeing people in America increase their debt spending across the board. Poor, rich, middle class, everybody is increasing the debt spending. And at the same time, we're also seeing people now start to dig into their savings as a way to continue maintaining their lifestyles. Because now when you compare the two evils, which is, do I go into debt to continue funding my lifestyle, or do I shrink my lifestyle? That way I can afford what I have. What we're seeing is most people are saying, I don't want to shrink my lifestyle. I'm just going to go into debt to continue funding my lifestyle because it's a lot harder, especially in the short term, to buy a smaller home, have a not as nice car, have not as many vacations, to have less things than it is to just put it on your credit card. So now we're seeing the debt spending rise. We're seeing people dig into their savings accounts. And so we're starting to see spending fall. And it's becoming tougher and tougher for the Fed to now inject more money into the economy because inflation is so high. The reason why the Fed has to keep raising interest rates and why they've been raising interest rates is because inflation still is not under control. And when you have inflation that's high, it's hard for the Fed to make credit and this other money more accessible to people because, well, that's going to make inflation even hotter. So now, this is that situation that we're in where we're now starting to see the spending slow down. And the question is, what's going to be the next domino to fall? I just hired a new team member for Briefs Media, and he told me that our onboarding process blew his mind. Not because of the work product or the process that we have at our company, but because of the money strategies that he saw. Let me show you. This is what the average person does. The average person makes money, and then they use this money that they earned to fund